Welcome to the third installment of our deep dive into the 2025 Tariff Blitz. We've covered the timeline, we've analyzed the technicals, and now we're going to examine the most important factor of all, the human psychology that drove every single move in this unprecedented market event. Here's what most people don't realize. Markets aren't moved by algorithms or fundamentals alone, they're moved by human emotions. Fear, greed, hope, despair. These are the real forces that create the massive swings we witnessed in 2025. Today, we're going to map out exactly how crowd psychology evolved through each phase of this crisis, following the classic market cycle that's been repeating for centuries. If you want to understand why $6.6 trillion vanished in 2 days, then recovered almost as quickly, you need to understand the psychological journey that millions of investors took together. Let's dive into the mind of the market. Let's start with election night, November 5th, 2024. This was classic market psychology in action. Before the results, we had peak uncertainty, and markets hate uncertainty more than bad news. Investors were paralyzed by indecision, sitting on cash waiting. But the moment the results were clear, that uncertainty evaporated. We saw a textbook relief rally as investors flooded back in. This wasn't euphoria yet, it was cautious optimism mixed with relief. Social media lit up with bullish posts, CNBC brought out the bulls, and everyone was talking about the business-friendly agenda. Here's the key psychological principle. When uncertainty is removed, even if the news isn't perfect, markets often rally. The human brain prefers known risks over unknown ones. That's exactly what we saw. Investors were willing to bet on a clear direction, even if it included potential trade disruptions. From November through January, we entered what I call the honeymoon period. This is where hope meets reality, and the market tries to figure out what's actually going to happen versus what was promised on the campaign trail. Psychologically, this was fascinating. You had 3 distinct groups: the believers who thought tariffs would boost the economy, the skeptics who thought it was all campaign rhetoric that would be watered down, and the fence-sitters waiting for concrete policy details. This created a perfect psychological setup for consolidation. Nobody wanted to make big bets either way. Institutional money was cautious, retail investors were optimistic but not euphoric, and the smart money was quietly positioning for various scenarios. The market was basically holding its breath. February 1st was the moment reality hit. When those first tariff announcements came out, 25% on Mexico and Canada, 10% on China, the psychological shift was immediate and dramatic. Now here's what's fascinating from a crowd psychology perspective. The initial market reaction was relatively muted. Why? Because we were still in the denial phase. Many investors couldn't believe this was really happening. There was still hope that cooler heads would prevail, that this was just negotiating tactics. But underneath the surface, anxiety was building. Corporate earnings calls started mentioning supply chain concerns. News headlines began shifting from pro-business agenda to trade war fears. Social media sentiment analysis shows this is exactly when the tone started changing from optimistic to worried. March was when anxiety accelerated into genuine fear. The tariffs were actually being implemented, rates were rising, and the market started forming those bearish technical patterns we discussed in our previous video. Psychologically, this is where the smart money started heading for the exits. These are the institutional investors who have risk management systems and can't afford to hope things will get better. They were the first to move from anxiety to action. But retail investors, they were still largely in denial. Classic cognitive bias at work. They focused on positive news, ignored negative signals, and kept buying the dips. Social media was full of buy the dip posts and diamond hands memes. The crowd was still fighting the trend. April 2nd was the day fear became full-blown panic. The universal tariff announcement was the psychological trigger that sent the entire market into what we call the capitulation phase. Here's what panic looks like in real time. Rational thought goes out the window. Price discovery breaks down. Investors don't care about valuations, they just want out. The VIX exploded above 60, which tells you everything about the fear levels. Social media became an amplifier of panic. Twitter was flooded with market crash posts, Reddit was full of loss porn, and even typically calm financial commentators were using words like catastrophic and meltdown. The crowd psychology had completely flipped from hope to despair in a matter of hours. Those 2 days in April, April 2nd and 3rd, represent one of the purest examples of capitulation in market history. This is the psychological phase where hope dies and is replaced by despair and anger. $6.6 trillion wiped out in 2 days. Think about the collective psychological trauma of that number. Millions of investors watching their retirement accounts, their kids' college funds, their life savings just evaporate. The news media went into full crisis mode. Social media was a wasteland of despair. Trader forums were full of people talking about getting out of everything and never trusting the market again. This is textbook capitulation psychology, the point where even the strongest hands start shaking. April 7th was psychologically critical, even though most people missed it. This was when the overnight futures showed that failed bearish breakdown we discussed in our technical analysis video. But from a psychological perspective, this was the moment of exhaustion. The sellers had literally run out of ammunition. Everyone who was going to panic had already panicked. The weak hands were gone. Here's a key principle of crowd psychology. Extreme sentiment readings often mark turning points, not continuation signals. When everyone is terrified, when the news is universally negative, when social media is full of despair, that's often when the best opportunities present themselves. The crowd is usually wrong at the extremes. April 9th gave us one of the most dramatic examples of emotional whipsaw in market history. When that policy pause was announced, the psychological shift was instantaneous and violent. We went from peak despair to cautious disbelief in a single day. That 9.5% surge wasn't just about the policy change. It was about a massive short squeeze as pessimists were forced to cover their positions. The same crowd psychology that drove the market down now drove it up. Social media was fascinating to watch. The same people posting despair memes 48 hours earlier were suddenly posting rocket ship emojis. The news coverage shifted from market meltdown to historic rebound literally overnight. This is crowd psychology in its purest form, completely emotional, completely reactive. Late April was psychologically fascinating because it showed the market trying to process what had just happened. We were in the disbelief phase of the cycle, that period where investors can't quite believe the worst is over. The psychology was split. Some investors were afraid to get back in, suffering from what we call crash trauma. Others were experiencing FOMO, fear of missing out on the rebound. The smart money was quietly accumulating, while retail investors remained largely on the sidelines. News coverage became more balanced, social media sentiment gradually improved, but there was still an undercurrent of skepticism. This is normal and healthy. Markets need time to heal psychologically after traumatic events. May 12th marked the psychological turning point where hope officially returned to the market. The US-China trade agreement wasn't just a policy development. It was a psychological catalyst that allowed investors to believe in the future again. The market's 3.26% surge that day was about more than the news. It was about the collective sigh of relief from millions of investors. Social media sentiment flipped positive, news coverage became optimistic, and the fear trade was officially over. This completed one of the fastest psychological cycles in market history. From hope to fear to capitulation to recovery in just over 4 months. The VIX collapsed from 60 back to normal levels, showing that the collective psychology had fundamentally reset. This is the summary of the timeline. Let's establish our psychological framework. Market cycles follow a predictable emotional progression that's been documented for over a century. It starts with disbelief, moves through hope and optimism, peaks at euphoria, then crashes through anxiety, denial, fear, and capitulation before slowly rebuilding through anger, depression, and back to reluctant hope. What makes the 2025 Tariff Blitz so fascinating is how rapidly we moved through these psychological phases. What normally takes months or years happened in weeks. We've traced this emotional journey step by step, because understanding crowd psychology isn't just academic, it's the key to surviving the next crisis. In our next video, we'll combine the news, technical analysis, and market sentiment to provide a complete analysis. Thanks for watching, and remember, markets are moved by people, and people are moved by emotions.